we're going to move on to just the Federal Reserve. What's going on in the Fed? You maybe have heard that interest rates are coming down, and we are seeing that. Rates are coming down. The Fed is going to cut, and they're continuing to cut rates. We think they're going to cut another quarter point here in the next week or two. And there's several different areas we could be in. I think we're personally in the top left sector of this, where the Fed is cutting rates and there is no recession within the next 12 months. And that happens at about 5% of outcomes. Now, most of the time the Fed is on pause and the economy is kind of churning along and there's no recession. But as of right now, the Fed is moving rates and they're cutting rates. And in this scenario, it's the strongest return on stocks that we've seen when you look at all previous historical metrics. Now, you can't say that past performance does not equal future returns, but this is a nice hint as the risk return that we may be taking when, even if there is a recession, stocks in the last 7% of time periods were only down 1.9%. So we're not forecasting a recession, but bonds have historically performed well in both scenarios. And most portfolios have a combination of stocks and bonds in them. All of our portfolios do. And they will benefit. The bond portfolio will likely benefit from this because when Fed cuts rates, bond prices move up and move higher, generally speaking. And so I think this is really nice and a really good news for just the message of staying invested and sticking to your plan, because we don't know the timing of returns. We don't know when it's going to happen, but over time, over a long period of time, stocks do well, bonds do well. That makes plans do well. It's just our job to manage the risk and return profile.